Imagine walking into a bank, depositing $1,000, and watching the teller tear up $500 before your eyes. Then they calmly tell you it's the smartest financial move you'll ever make. You would call it theft. You would call it a scam. Yet when that same structure is packaged in a leather folder and labeled whole life insurance, many call it sophisticated planning. This is not an emotional debate. It is a structural one. Today, we examine permanent life insurance versus the strategy known as buy term and invest the difference. We strip away the sales language and examine the math, because the math determines whether this decision builds wealth or quietly destroys it. Let's define the battlefield. Term life insurance is simple. You pay a relatively small premium for a fixed period, 20 or 30 years. If you die during that time, your beneficiaries receive the payout. If you survive, the policy expires. It is pure risk protection, nothing more. Whole life insurance is a bundle. It combines lifetime insurance with a cash value component marketed as a savings vehicle. The pitch is attractive. Permanent coverage, tax advantages, steady growth, safety. It sounds responsible, mature, strategic. But the cost structure tells a different story. Take a healthy 30-year-old seeking $500,000 of coverage. A 30-year term policy might cost $25 to $40 per month. A comparable whole life policy can easily cost $400 to $500 per month. That is a tenfold increase. The insurance agent will say the difference is not wasted. It builds cash value. But before we assume this is a smart trade-off, we need to examine what happens to those premiums. In the early years of a whole life policy, a significant portion of your premium does not build cash value. It pays commissions. It pays administrative costs. It pays the insurance company's risk reserves. First-year commissions often range from 50 to 90% of the premium. That means if you pay $10,000 in year one, a large portion never becomes your money. As a result, your cash value in the first few years is often minimal. Many policies take 10 to 15 years just to break even, meaning your accumulated cash value equals the total premiums paid. For a decade or more, your internal rate of return can be negative. If an investment guaranteed a negative return for 10 years, you would reject it immediately. But because whole life blends insurance and investment, the poor investment performance hides behind the insurance justification. Now, let's examine the alternative. Instead of paying $500 per month for whole life, suppose you buy term coverage for $40 per month and invest the remaining $460 into a diversified index fund. Over 30 years, assuming a conservative 7% annual return, that invested difference compounds significantly. Run the numbers. $460 per month invested at 7% for 30 years grows to approximately $550,000. Meanwhile, many whole life illustrations project cash values in the $250,000 to $300,000 range after similar contributions. The difference can exceed $200,000. That is not theoretical. That is opportunity cost. The whole life policy offers predictability. The investment strategy offers volatility. But over long time horizons, diversified equity exposure historically outpaces the low single-digit returns typical of permanent insurance policies. Inflation compounds this problem. If a whole life policy grows at 3 to 4% annually, and inflation averages 3%, your real return approaches zero. Purchasing power stagnates. Meanwhile, equities and real assets historically exceed inflation over extended periods. By choosing safety at high cost, you may be taking a different risk, the risk of insufficient growth. Supporters of whole life often highlight dividends, but in insurance terminology, dividends are legally defined as a return of excess premium, essentially a partial refund when assumptions exceed expectations. They are not equivalent to corporate profit distributions from equity ownership. They reduce cost, they do not transform the structure. Another popular variation is the infinite banking concept. This strategy involves overfunding a whole life policy and borrowing against its cash value to finance purchases, supposedly becoming your own bank. Here's the structural reality. When you borrow against your policy, you are not withdrawing your money. You are taking a loan from the insurance company using your cash value as collateral. You pay interest on that loan. Yes, your cash value may continue to grow, but you are still paying a spread to access liquidity that you funded. If you fail to manage those loans carefully, interest compounds against you. In extreme cases, policies lapse, triggering taxable events on previously deferred gains. Complexity increases, flexibility decreases. In contrast, a brokerage account invested in low-cost index funds is liquid. You can contribute more, pause contributions, reallocate assets, withdraw capital without negotiating loan terms with an insurer. Simplicity has strategic value. Now, to be precise, whole life insurance is not universally inappropriate. There are narrow cases where it serves a specific structural purpose. Ultra-high net worth individuals facing estate tax liabilities may use permanent insurance to provide tax-free liquidity for heirs. Families with special needs dependents requiring lifetime financial support may require permanent coverage beyond working years. High-income individuals who have fully maxed all tax-advantaged retirement accounts and seek a conservative fixed income substitute may use whole life as a bond alternative. But these are advanced scenarios. They are not typical. For most households, insurance is a temporary need. It exists to protect dependents during working years while assets accumulate. Once investment accounts grow sufficiently, self-insurance becomes possible. Term coverage bridges the gap. Investing builds the foundation. When permanent insurance is sold as a primary wealth-building vehicle to young earners with debt and limited savings, the misalignment becomes clear. The critical insight is this: insurance and investment are two separate problems. Insurance protects against catastrophic loss. Investments build capital. When bundled, costs rise and transparency declines. The disciplined strategy is straightforward. First, secure adequate term coverage before canceling any existing policies. Health status matters. Ensure replacement coverage is active. Second, evaluate existing whole life policies objectively. Past premiums are sunk costs. The decision is forward-looking. Compare projected returns to alternative investment strategies. Third, automate the investment difference. If you save $400 per month in premiums, that money must flow directly into a diversified portfolio. Without disciplined reinvestment, the strategy collapses. Financial independence is built on compounding, cost control, and behavioral consistency. Whole life thrives on fear. Fear of market volatility, fear of insufficient discipline, fear of missing a guarantee. But guarantees come at a price. The question is not whether whole life is legal or contractual. It is whether it is the most efficient structure for your capital. For the majority, unbundling insurance from investment reduces fees, increases transparency, and enhances long-term growth potential. Before accepting any financial product, ask one question: who benefits most from this structure? Follow the money. If this analysis clarified the numbers behind permanent life insurance, subscribe to CAPITRO Mind for disciplined financial breakdowns. Comment below, I choose math over marketing, if you prioritize structural logic over sales narratives. No one cares about your money more than you do.